Ventures has announced an initial public offering of its equity share through both fresh issue as well as offer for sale. The price band has been fixed between 140 to 148 per equity share, and the issue will open for subscription on June 30. To know more about the company's business and the financial profile, we've been joined by Pravin Kumar Agarwal, the CMD of the company. Hello and welcome to Money Control. I'm going to start off by asking you about the basic core competency of the company. What do you identify yourself as? You have across the board, you have segments like hospitality and FMCG. The company seems to be venturing out pretty much in all the profiles or all these segments right now. How would you identify yourself?
No, it's not. We are not venturing into many things. Actually, it was always forward integration or either backward integration. We predominantly are a hospitality company. You all in Mumbai have heard our brands called Golden Chariot and the Balaji. Golden Chariot is the non-veg fine dine bars, and Balaji is the pure vegetarian restaurants. So, starting from background of restaurants and other services, we ventured into making our own hotels. So, in 2014, we made our first four-star hotel. So, after that, we have been progressing ourselves into construction of hotel projects and similar projects, where we specialize in construction and finishing a hotel. So that is why we have ventured into a construction division also. First, making our own hotels. Then we bagged a very prestigious project of constructing the Delhi Police Headquarters. That is a 10 lakh square feet building in the year 2016, and which got completed in 2021. It's a complete plug and play building with all the furniture, with all the air conditioning, and 100% works done by us. And it's a BOT project. So we are specializing in hospitality and construction. These are the two verticals that we are working on as of now.
Sure, you said essentially you would like to classify yourself as a hospitality business, but
Yeah.
also part of your, if you look at the business profile of the company, I'm checking into the financials, it's
Yeah.
more tilted towards the construction segment than the hospitality. In fact, the IPO proceeds too will be invested in the construction business, which is relatively low margin and comparatively high risk business, especially for new players. Can you explain your rationale behind this?
No, if you see in the last 23 years of our existence, we have grown at a CAGR CAGR of around 20% year on year, always. So we have not been doing any business which gives us less profits. So our focus is very clear. Our fabric is we have generated our own revenues and grown. We have not taken debt. We are very, very low on debt. We have not taken external funding ever. So we are very focused and we do businesses where we make money. So construction also, if you see our object of the issue, the Halai Pani hydro project, because we have done a third party hydro project, that is why we have bid for a hydro project, which gives a IRR of 18 to 20%. It's a small hydro project. It's not a large type that you think. It's so every year the revenues will be around 25 to 30 crores, which is after the capital is a IRR of at least 18 to 20%.
Sure. If I was just looking from a very layman perspective, 45%, 40% is your margin, EBITDA margin profile. Could you give us a split of how much of margin contribution comes in from hospitality, how much of that comes from construction, and how much of that comes from management service, just to understand which of the one is more high yielding in nature?
So what is happening? We are making a EBITDA level of around 20% in hospitality, 20 to 22% in construction. But since we have an annuity income, that adds up into the EBITDA levels, and this annuity is going to continue for another 10 years. We are getting annuity of our share of PKH Ventures is around 30 crore rupees every year. So that is why you see the other incomes and financial incomes separately. So that is why the EBITDA levels are high.
All right. One of the things where you often spoke about this power plant, it's getting into a newer area in the construction business, such as building and operating a power plant, which is also, an entertainment hub also for that matter. That poses a lot of uncertainty and risk to your future cash flows too. which at this point of time for the last 3 years have been negative.
No, cash flows have not been negative. Sorry, matlab, I'm telling you that we have had a always a healthy balance sheet. Our profits in the last year was in the financial year 22 was 40 crores, and we'll better that in this year. So our top line also is going to grow by 15%. So it has never been a cash flow, only certain periods of the time, because EPC business, sometimes the billing happens only in the last quarter. As you understand, the clients want to use the budgets and everything. That is why you must have feel in the last year, last 2 quarters, the billing has happened late. But you see on the debtor side, there's a lot of billing to happen. So that is why there is no cash flow shortage as
All
such.
right. Also, let's talk about your top line growth in that case. A little bit of degrowth which has come through apparently in FI as compared to FY22 to FY21. I'm not talking about the FY23, which is 9 month statement out there. Just a like to like comparison there. A bit of deacceleration coming in on the top line performance. What explains that, and
Yeah,
what can be
see.
expected going forward?
So our growth is going to be, we are going to maintain a healthy growth rate of 15 to 20%. 21, as you know, the hospitality sector was a very, very badly hit sector. It was just coming up with the COVID levels. So hospitality was a little bit hit in those years, but we did fantastically well in the construction division. That is why our balance sheet has not taken a hit anytime, because we are a little bit diversified, as you feel, but we are able to balance both the things because both are our focus areas. We have specialized teams and vertical heads taking after both of them. So that is why it's not a very so we have maintained that even in the COVID periods.
There was this order cancellation which has been observed in for the 9 month ended FY23. 256 odd crore order inflow has been cancelled, which perhaps highlights the risk of entering into new set of business. So I wanted to understand, not a cynic here, but just playing the devil's advocate just to get the financials right on board.
Yeah.
Essentially, what are we? Don't you think building up with a power plant and the existing order flow also going off, and the order inflow getting cancelled? Don't you think that poses a bit of risk on your financials?
No, your observation is absolutely bang on, but I will give you explanation. What happened after the COVID level? Some projects were the clients were not ready to pay or they were not ready to invest. There was slowdown in the real estate sector per se. So some orders which were stagnant, we just told them to cancel them. That is why we have not carried them on. But we have got new orders. So we have shifted. So if we are not taking over a order book, just continuing just because if the project is held up. So that is why we have got them cancelled. The clients, we have told them that if the work is not happening, let's cancel that and move on. That is why we have taken new orders. There is a particular limit of orders that we can take. No? So that is why that cancellation happened and we took new orders.
Again, on the possible growth on top line story. Correct me here if I'm wrong. A 17% decline on the top line. Uh, we saw growth coming in 20 to 21 to an extent of 46%. That's a year on year growth I'm talking about. And now you're projecting a top line consolidated growth to an extent of 10 to 15%. Have I got that right?
Yes. See what happened in that year. Our major project we have invested 440 crores in the Delhi project, which got completed in 2021 March. So all the revenues of that project got kicked in. So COVID period 1 year did not get paid, and we got paid in the next year. So that is why you see a little bit uptick on that side. After that, the order cancellation, because the markets were slow, the capital investments were slow. So now we have picked up, and every year now see if you must also understand that we are growing internally. We plow in our profits to grow, and now that we are taking the construction division also is taking a working capital of 80 crores, so we'll have much of bandwidth to grow faster.
I wanted to understand the company's strategy exactly with in terms of what they're trying to do. Why are they going so? I mean, why you guys are going so heavy on your construction business, which apparently is low yielding as compared to a hospitality business. IPO proceeds are also being, diverted to that. Right now, the company seems to be following an asset light model, but it plans to build on the design, build, finance, DB, FOT, and HAM project. That's also, is the company changing the strategy from being asset light to an asset heavy model?
No, see, we are going into a business which is so high in returns. We are going to get an 18 to 20. If you have seen the DPR of our project, we are going to get a IRR of 18 to 20% for next 50 years. It's a 50 years BOT. And since our intrinsic strength is civil works, 60% of that work is civil work. So we are going to do it departmentally. So you can understand our focus on that area. We have taken one project which we know very well. It is going to be executed in the next 18 months. It's not a greenfield project. It is a project where government has started and they somehow, due to some problems, had to abandon the project. Then they called for a tender on BOT basis. In 2020 October, we have taken this project. So you can imagine, in a very competitive world, if you get such a project which is so lucrative and we have the intrinsic capacities to construct and complete it, so why not? That was our strategy, and it gives a return of 18 to 20%. We are not talking about low margin businesses. We are never, even the construction, we are doing very specialized construction. So it's not a low margin business ever as a fabric of the company.
So, how much is your construction margin EBITDA expected to improve with the upcoming projects that you have in that case?
Yeah, so EBITDA margins are going to be retained. We are going to better them as per the past. We have always made 18 to 20%, and we are going to be going better in that.
15 to 20%, and how much better can we expect in that case with the change of a little bit of strategy and the order profile that is coming through?
Yeah, so I expect that we must do at least 25% better on what we have done in the past.
Are you talking on the EBITDA front, 25% better as compared to what
On
you've
the
done?
construction side, yeah, because we are
That's
choosing projects
construction.
on.
And overall, how much do you expect this 25 margin improvement in the construction side in
25%
the
of the
span of
existing
1 year?
projects. Yeah, in the immediate future, we are doing that.
Okay, and with that, how much is your overall margin profile going to improve?
So just now it is around 20 to 25% of EBITDA levels. If you keep aside the annuity income, so that is going to be plus 5% here and there. We are going to add up in that.
Okay, so 5% increment overall coming in the near term with the expansion of the construction margin profile. Have I got that right?
And even we are doing our own hotels. You see, we are going to build 3 new hotels within the next 18 months. We have already got the award for a 90 years lease. So we are going to do it. The construction division is going to complete those projects. So the hospitality sector gets a ready-made project to run because of the construction division doing a good job, a speedy job, a better job than outside agency.
Mr. Kumar, just to consolidate this for our viewers, 40% was the margin profile as of FY22.
Yeah.
So now with 5% increment coming in from the construction division and also some amount of changes that are happening in terms of the capacity expansion taking place in the hospitality division, overall we're looking at maybe a 50-55% kind of margin profile in the ongoing financial year. Have I got that right?
No, it is going to be around, I think, around 45% in the current year. In the next years, it is going to increase because our debt levels are very low. Our EBITDA margins are very high because we are very low on debt.
All right. I have two more questions for you. Almost 60% of construction and development segment revenue comes from Delhi Police. Any intent to diversify that?
No, there is no intent to diversify that.
Okay. The final question that I wanted to understand was bit from the FMCG perspective, Mr. Kumar. The company is in process of completion of the acquisition of a public listed company, which is Amar Remedies, which is in probably an Ayurvedic product segment through the IBC process for 31.6 crore, if I'm not wrong.
Yeah,
NCLT has already approved the acquisition,
yeah.
but due to the statutory period, it has not been, the acquisition under resolution plan has not been completed. It's expired. How does that shape up for the company? When can you provide us with the timeline as to when do you expect to complete the process of acquiring this company, and what kind of revenue growth can be looked into from this FMCG company? How will that foray in more product profile for the company?
Yeah. So what happened? This company was shut down by the lenders. It was a running company. The machinery and all is a little bit old, but it was all in place. They were doing very well, but due to some reasons, so what I feel is NCLT also has approved our plan, but there was a certain hiccup because of change in law of the 95% holding and the 100% holding. We have asked for 99.96% holding, and the government came up with the law of 95%. So a little bit of dispute is going on. We are trying to solve it as soon as possible. As soon as that is solved, we have already, the assets are in our possession already. So we are trying to complete all the formalities of listing and everything. And then there is a proper board, a professional board managing that company. That's going to be a different vertical with professional people running it.
But Mr. Kumar, what is the rationale, Mr. Agarwal? What is the rationale behind, behind going for the company, FMCG Ayurvedic product company, and how does that add to the top line growth in that case?
It is not a Ayurvedic company. It was a lifestyle product company. It was doing everything from deos to perfumes to everything. So that is a separate vertical that we thought is a very good vertical. It was at a very low cost price. We have got it at a very good price because there was no competition at that time. If you see, the real estate value also is very high. So I am thinking that it's a very good decision. Maybe the market perceives it otherwise, but there is enough literate people in the industry to run that company on a very professional manner. Even the old employees of that company we have spoken to them. Once they are on board, it will be doing well, and we expect a top line of at least 200 crores from that company, because it has got 3 plants which are huge capacity plants. Even third party OEM also is possible from that plants.
That's huge. That 200 crore figure at least looks attractive on paper.
It was doing, I'm telling you, it was doing that much business. At the time, it was when it was shut, it was doing that kind of business. I'm telling you, not I'm not talking about the future. I can't talk about the future, but it was doing at that time. So it has the capacities to do a lot of business.
Okay, and what's the liabilities that the company will have to take on book with this? And has it
So there's
been
no
factored
liability. We are
into
getting a
financial?
clean slate. We are just bought the company for 31.5 crores. It's a clean slate. There is no liability on it. Absolutely no liability. We are going to get a clean slate.
All right, so no debt, anything coming in from that one.
No,
There's a
no.
haircut which has already been.
Absolutely,
What's
NCLT
the
process is
haircut
very
taken on
different.
this one? Just to understand how lucrative this acquisition look with a 200 crore kind of a revenue profile coming in from the from a FMCG company.
Yeah, I think the debt size or the book, the total claims were around 600 or 700 crore, if I remember correctly. Maybe a little bit here and there. But yeah, that was the value we got it at. There was a 600 or 700 crore claim on that company.
So I just want to understand one last thing. The approvals tentatively are expected to come in this financial year, or can we factor out this financial year and probably look at FY25 for acquiring and integrating this company into your financials?
No, I expect that within 1 or 2 months we'll have some result out of the courts. So we will do it very aggressively, and we'll, because that company to begin operations is just a 6 months job. The factory has already been handed over to us. We are in possession, but the formalities are not yet complete. So I think to 6 to 8 months, if we get it right, so we'll be able to start the production within this year, if everything goes well. Fingers crossed.
Okay, so 6 months for the factory to start, 2 months coming in for the approvals to come in, as per your estimate, gives an 8 months. So probably you're looking at somewhere, we are looking at
These are
Feb,
ambitious
March
figures.
kind
Don't
of.
take me on that. I'm just estimating it to be right. I'm telling you, fingers crossed. We are expecting it to start operations within this financial year. Then this is a
Okay,
great expectation, the ambitious expectation. Don't take it otherwise. Yeah. But the
one last
company is not.
question, Mr.
Company is
Agarwal, that I have.
very. Sorry.
Please go
Yeah.
ahead.
Sorry.
Please
Yeah.
go ahead.
No, the company is having a lot of assets. It has a lot of potential. That is why this decision is a very calculated decision. If you feel right, the claims on the company was 700 crores and we acquired it for 31.5 crores. So you can imagine how well we have done that.
Okay, Mr. Agarwal, one final question that I have in my mind is the IPO is partially made of OFS, right? It means that
Right.
promoters are diluting roughly around 30% stake. Correct me here if I'm wrong. For the last 3 years, I read the RHP. The promoters have been gradually acquiring stake, the share price to an extent of 120 rupees per share. Additionally, bonus has been issued to an extent of 3:1. And now, is this more of capitalizing the market momentum game rather than strategically wanting to grow the company? How are you looking at it, and why the SOFIS in the first place?
No, no, it's only 9% of the. We are totally diluting around 31%. Out of that,
Right.
9% is my dilution. So this
Okay.
has been because we have pumped all our life into it. We have always plowed in back the money. The company has assets worth around approximately around 500 600 crores. The net worth of the company is 300 50 crores odd. So we are just taking a part of my whole life I have spent on this company. So a little bit of it's a 9% OFS. So it's not much. As per me, it's a very, very fair decision. The promoters are entitled to something at least.
Sure, I'm not denying that. Just wanted to understand
Yeah,
the
I,
reason for the
I
OFS,
think I have
because
answered your question.
incrementally all the companies this time around, with the markets being at record high and the IPOs that we're seeing, the flurry of IPOs that we're seeing, part of them are OFS, which makes us want to question whether it's just another company looking for an promoter looking for an exit opportunity, or it's actually something in for the retail shareholders for there as well.
No, I'll tell you. See, this process starts 1 year back. We are lucky, God is kind, that the markets are all-time high today, and they will prosper. India is a story which is just starting. I think all our businesses, both our businesses, the hospitality and the specialized construction or execution, is are the two verticals which are going to grow leaps and bounds. So we are into the right industry. That is most important. Plus we have a very robust working mechanism. That is why we have grown over the years. I have started working at the age of 18. I have brought the company up till here, so a little bit of wealth for me. And all other companies, if you see, the OFS has been 100% also, and we are just diluting 9%. And we have not planned this. This is the process has taken almost 1 year. So it is not today that you have planned this. This can't be planned at the last moment.
Sure, Mr. Agarwal. Point well taken. And thank you
Thank
for
you
all
very
the
much.
clarification and the understanding that you've provided us thus far.
Yeah.
But viewers, with this, it's a wrap. Thank you so much for tuning in.
Thank you very much, ma'am. Thank you very much. So nice of you. Thank you.